We head to Nigeria because Nigerian financial experts are engaged in contrasting agreements on the rate of monetary lending by the country's central bank. It is not clear whether the decision to reduce the interest rate could open for more lending in the banking sector would be approved by the financial institution. Experts are also divided on whether the country should go back for recession as projected by the government and the International Monetary Fund. Details of that in this report.
The decision by the central bank to cut the benchmark interest rate took quite a number of close watchers of the economy by surprise, and it has divided opinion among the experts, with the main argument centering on the monetary lending rate and the cash reserve ratio, which the MPC retained at 27.5%.
Even though cash reserve requirement, the rates could have been adjusted, but the one that is mostly efficient is the adjustment of monetary policy rate.
I don't think the monetary policy rate is a major determinant of lending rate in the market today. So in that wise, I wouldn't think adjusting the monetary policy rate will have any material impact on the lending rate or the available credit in the market.
It remains to be seen whether the decision to lower the benchmark interest rate would spur more lending in the banking sector and generate economic growth, which is what the central bank is targeting. While the Nigerian government and the IMF have projected the country would slide back into recession this year, the Apex Bank is bullish that could be avoided. It's a position that is also dividing opinion.
I think it's inevitable. Nigeria will go into a recession because when you look at our export, our current account is negative. When you look at our export as completely reduced, when you look at our import also significantly reduced, exchange rate, foreign reserve has contrasted.
Nigeria can actually sidestep an economic recession, and I'll tell you why. Because for you to have a recession, you must have two consecutive quarters of negative growth. We are likely going to have a negative growth in the second quarter of this year. But the third quarter, which will be the period July to September, may not have a negative growth.
But even if Nigeria avoids slipping into recession by the end of the year, there are fears the country may not be able to avoid a second devaluation, especially if oil prices continue to remain low.
The reasons why I don't think the central bank will have a compelling need to devalue the currency is because we are seeing recoveries in oil prices. We're also seeing rebalancing in crude oil market.
Devaluation may not necessarily happen if before the end of June oil price climb up to $40 a barrel. But if it does not, then it will become inevitable.
There's no certainty about the Nigerian economy at the moment, and this is likely the result of low oil prices in the global market. The country's oil monopoly NNPC recently disclosed that it is still looking for buyers for its crude oil, whose demand has dropped due to the coronavirus pandemic. But with more and more countries easing their lockdowns, there's hope demand for oil will rise. How quickly that happens could make the big difference for Africa's largest economy.